Welcome to our Get Your Super Sorted session. At Statewide Super, we aim to inform our members so they can make the best decisions for their financial future. As we're working through our career, we get accustomed to a lifestyle that our regular income affords us. Once we stop working though, we have to have a bit of a think about how we're going to continue to fund that lifestyle. And that's where superannuation comes into play. In Australia, the money we save through super has tax advantages to help encourage us to save. Money that our employer contributes to our account, or money we contribute ourselves, is typically going to be taxed at 15%. So how does super work? Let's imagine this pot here is your super account and have a look at some of the ins and outs of superannuation. The government has some rules in place at the moment that say 9.5% of your ordinary time earnings, which is similar to your salary or wages, has to be contributed to your super account on a regular basis. These are called super guarantee payments. You can also contribute money yourself as well. When contributions are paid into your account, most super funds will invest the money on your behalf to grow your super balance. Fees and any applicable taxes will be deducted along the way as well. If you hold insurance through your super account, you may also be paying insurance premiums as a result. Is your super healthy and working hard for you? We know when it comes to superannuation, there's lots of complex terminologies, a bit of jargon thrown around. That's why the team here have developed a superannuation health check, and we're going to work through the top 7 topics on the health check as well. So let's start with number 1 on the super health check, contributions. Contributions must be paid from your employer on a regular basis, at least quarterly. You're also able to contribute funds to your superannuation account from your before tax salary. This is known as salary sacrifice. Let's take a quick look of how this example works. Let's assume this person here, they've decided they can save $100 per month, and they're just trying to work out if they should do it through their bank account or if they should do it through their superannuation account. For this example, let's assume they're earning about $50,000. On the left-hand side of the screen here, they've worked out if they save the $100 through their bank account, once they get their marginal tax rate taken out of about 34.5%, they're left with $65 in their account. Now they may intend to invest that money, save it, but the reality is a lot of Australians aren't good savers and we tend to spend that money when it's in our bank account. On the right-hand side of the screen, they've worked out if they save that same $100 through their superannuation account, because they're only going to be taxed at a rate of 15%, they're going to be better off by about $20 in their superannuation account. Doesn't sound like a big amount at the moment, but over the long term, it adds up to a significant difference to someone's retirement balance. There's 3 main ways you can grow your superannuation account. One being before tax contributions, so that's going to include your super guarantee payments and any salary sacrifice payments you're making to your account yourself as well. The government has some rules in at the moment that says you can only put in a maximum of $25,000 in any given financial year. You may also choose to contribute to your super account after tax. These are known as personal contributions. Because you've paid tax on these amounts already, the funds you can contribute to your super account are going to be a lot higher. People may choose to make these personal after-tax contributions in order to receive a government co-contribution. The co-contribution you receive into your account is largely going to be dependent on your income levels. Let's work through number 2 of the super health check, consolidations. Many people may not realise they have multiple superannuation accounts out there. If you do have multiple superannuation accounts, the chances are you may be paying 2 lots of administration fees, and if you hold insurance through any other super account, you could be paying multiple sets of insurance premiums as well. At Statewide Super, you're able to jump online or use our mobile app to see if you have any lost or unclaimed super out there. Before consolidating your accounts though, you might want to consider the fact that if the second superannuation account you're looking to transfer has insurance attached with it, the insurance will be lost upon transfer. Investment choice. When funds come into your super account, they are invested for you. So it's really important to consider how long your super is going to be invested for. The length of how long your super will be invested is largely going to dictate where your investment option should be sitting. Diversification is a key principle when it comes to investing. It's a good idea to have multiple funds invested in different asset classes In the event that one asset class isn't performing too well, you've got a mix of others to help spread that risk over time. Think of it as not having all your eggs in the one basket. And it's really important to remember that you've always got choice of where your superannuation funds are invested. At Statewide Super, there's 10 different investment options that you can choose to invest your funds into at any point in time. Most super funds in Australia will have a default investment option, and they're usually going to be called My Super. This allows people to easily compare how the investment performance between one My Super option is performing against another super fund. Statewide Super's default My Super investment option has an element of risk because it's roughly invested 50% in the share market, both in Australia and overseas. To help spread some of that risk, we have funds invested in more defensive assets like cash and bonds. Funds are also invested in infrastructure assets like Flinders Ports and Adelaide Airport to help smooth investment performance over time. Depending on market conditions, our investment team will invest either more or less in certain asset classes within the percentage range on the right-hand side of the screen. At Statewide Super, the majority of our members have their funds invested in our default My Super investment option. Just remember, because we default you there doesn't mean it's going to be the right investment option for your circumstances. Our investment options range in levels of risk associated with them. We know everyone's circumstances are a little bit different, and their approach to investing will be unique to them. That's why it's important to remember you do have a choice of where your funds are invested. It's important to know where your funds are invested and what sort of percentage return you're receiving. Even a 2% difference in investment returns can add up to a significant difference to someone's retirement balance at the end of the day. That's why it's really important to remember to regularly review your super, and always remember you do have a choice of where your funds are invested. It's important to remember if you are thinking about making an investment switch, you should seek financial advice first.
Now we're covering number 4 on the health check, insurance cover. We often insure our homes and our cars, but the most important thing for us is our life and our ability to make a living. Although we don't like to think about the worst case scenarios, it's really important for us to consider the what ifs. This ensures that we have the appropriate measures in place to lessen their potential impacts. Statewide Super has 3 types of insurance: death, total permanent disablement, and income protection. The death insurance is a lump sum payment paid to your beneficiaries in the unfortunate circumstance of your passing. Total and permanent disablement is a lump sum payment that's paid to you if you're never able to return to the workforce due to sickness or injury. Income protection is a monthly benefit that's paid to you on a temporary basis if you're sick or injured. Total and permanent disablement and income protection have waiting periods that apply. For more information, please refer to our Insurance in Your Super booklet, which can be located on our website. All insurance requires you to pay premiums. The benefit of having your insurance through your superannuation is that your premiums are deducted out of your super balance. At Statewide Super, we offer insurance based on 3 occupational categories: standard, white collar and professional. You may be eligible to receive cover at a reduced cost if you fall within the white collar or professional occupation category. When you receive your insurance cover, you're classified as a standard occupation. However, you may be eligible for cover under white collar if your duties are primarily of clerical, administrative or management nature. 90% of your duties are undertaken in an office environment and none of your duties are of manual nature. You may also be able to be reclassified under professional. To be classified as professional, you would need to meet all the criteria for the white collar occupation category, plus 100% of your duties would need to be undertaken in an office environment. You would need to hold a tertiary qualification relevant to your current occupation, or are a member of the relevant professional institute of your occupation. Or you are engaged as a senior member of your employer's management executive team and you need to be earning over $100,000 per year. Now we're going to cover off number 5 of our Super Health Check, beneficiaries. Beneficiaries are really important to update. A lot of people don't realise that their super doesn't form part of their estate. It's very important to nominate a beneficiary, as they will be the ones that receive your super and your insurance benefit in the event of your death. A beneficiary must be a dependent. A dependent is your spouse, including a de facto or same-sex, a child, someone in an independent relationship with you, or another financial dependent. Or it could be your legal representative, such as your will. There are two types of nominations that are available to you, a preferred nomination and a binding nomination. With the preferred nomination, as the name entails, it is your preference. And the super fund will take that preferred nomination into consideration, but it's not guaranteed. The other option is a binding nomination. With a binding nomination, you will fill in a legal document that binds your nomination to the super fund. What that means is if you were to pass, that money would go to your nomination with no questions asked. It can't be contested, and it means that the payment is made in a timely manner. With Statewide Super, the binding nomination will last for a period of 3 years. You will receive notification to advise you that your binding nomination is due to lapse. You will then need to recomplete the binding nomination form. If you don't complete the form, you will still retain a beneficiary, but they will be preferred, not binding. When nominating a beneficiary, it's important to remember that there may be some tax considerations. If you feel this may affect you, please seek some financial advice.
Let's have a quick chat about number 6 on our super health check, fees. It's important to know, what are you paying for your super? What are you paying for your insurance through your super? And even speaking more broadly, what are you paying for the services in financial services in general? And ask yourself the question, am I happy for the service that I'm getting for the funds that I'm paying? Once we've had a chance to review the previous 6 topics on the super health check, we're now at a review stage. Super doesn't have to be something that you look at every single day, but it's a good idea to check in with your super account and see how it's tracking every couple of years. If you've ever had any significant life events recently, such as getting married, having a child, purchasing a house, these should all serve as a bit of a prompter that you may need to take some action on your super account. To help review your super account, you can also jump onto Statewide Super's website. It has a vast range of lots of tools and resources and some useful fact sheets which detail a lot of information that we've covered through our session so far. You're also able to jump onto the website and review your own personal super account, see how your balance is tracking, transactions, and have a look at how your funds are performing. We also have a mobile app available to our members, which acts similar to any internet banking mobile app. It's going to be a 4-digit PIN once you register for your online account access, and it's a very quick and simple way to review your super account whenever you like. When can you get your hands on the super? It's generally going to be everybody's number one question when it comes to superannuation. There's no rules when you can retire at any age. When you can access your super is going to be determined by your date of birth. The technical term for this is your preservation age. For anyone born after 1 July 1964, you're going to have to wait until you're 60 years of age in order to access your super if you meet a condition of release. There's 3 main triggers of when you can access your super account. The first being meeting your preservation age, as outlined on the previous slide, and permanent retirement from the workforce. The second being, once you're 60 years of age and you cease employment with 1 or more employers, you then have met a condition of release and you're able to access your super. In a fund like Statewide Super, if you're over the age of 60, funds you draw down from your super account are typically going to be tax-free. The third trigger of when you can access your super is when you turn 65 years of age. It doesn't matter if you're working full-time, part-time or on a casual basis, you can access your super anytime you like. At Statewide Super, there's 3 different levels of financial advice that we provide to our members. The first one is general advice, where we can help tidy up a few things, be it nominate a beneficiary, help you review your account balance and get you registered online. If you're a Statewide Super member, you're also entitled to personalised financial advice. This means you can have a face-to-face appointment or a phone-based appointment with an associate financial planner, and they can help work with you to determine, are my investment options right for my circumstances? Should I review my insurance cover? And if you're thinking about implementing a contribution strategies, the associate financial planners can help prepare a statement of advice for you as well. The third tier of advice that we offer at Statewide Super is comprehensive financial planning. There's a no obligation initial meeting. If you proceed with advice, it's then a fee for service model. If you'd like any more information about what we've spoken about today, don't hesitate to get in contact with us.
The advice in this video is general advice only. It may not be appropriate for you, and we recommend you obtain independent financial advice and consider the applicable PDS before making an investment decision.